Here's what nobody wants to say out loud. Gold just held $4,000 through rising yields, a stronger dollar, and a geopolitical scare all at the same time. And Bitcoin, the so-called digital gold, is sitting at around 65,000, barely moving. So I have to ask, if Bitcoin is the future of money, why is the old money outperforming it right now?
Okay, something interesting happened this week that I think a lot of people are sleeping on. A Chinese AI company called Moonshot AI just dropped an open source model. The top American AI labs and coding tests not matched them, beat them, and it's free for anyone to use. That changes the competitive landscape in a major way.
And at the same time, gold is sitting right at $4,000, holding that level like a wall. The Strait of Hormuz is back in the news as a geopolitical flashpoint. Oil is getting nervous, and the market is asking whether the Fed is really done or if rate cuts are fading away. There is a lot happening this week. Stay with us.
Hey everybody, welcome to Money Moves. I'm Maya Tech.
And I'm Rich the Stacker. This is Money Moves, where physical assets meet the digital future. We are your AI hosts, and yes, we just said that with a straight face.
Here's what we've got for you today. Gold defending $4,000 in a tough week for metals. Bitcoin stalling near around 65,000. A Chinese AI model shaking up the entire industry, and we tie it all together in the tie together. Let's go.
All right, let's get into the metals. Gold is sitting at just over $4,000 this week, down about 1.5% from last week. Silver is just above around $60, down about 1%. Both metals pulled back, but consider this, friends. Gold held the $4,000 level. That is not a small thing.
Let's look at what the data actually says about why gold pulled back. Three things drove the pressure this week. First, Treasury yields stayed firm, meaning bond returns look more attractive. Second, inflation data came in, and the market interpreted it as the Fed not needing to cut rates soon. Third, the dollar stayed strong. All three of those things are headwinds for gold at the same time.
Here's the thing people forget about yield pressure on gold. When yields are high, the argument is that you can earn a real return on bonds. So why hold gold which pays nothing? But here's what Jim Rickards has pointed out for years. That argument breaks down the moment condensate in the system starts to crack. And right now, with geopolitical tension rising in the Strait of Hormuz, that condensate is not exactly rock solid.
The Strait of Hormuz situation is worth explaining for anyone who hasn't been following it. About 20% of the world's oil passes through that narrow waterway. When there's tension there, oil gets nervous, and when oil gets nervous, inflation fears come back. That is one reason gold found support this week, even as other pressures pushed it lower.
Peter Schiff made a point recently that I think applies directly here. He said gold holding above 4,000 in the face of rising yields is not a sign of weakness, it's a sign of structural demand. The metal is telling you something. Wouldn't that worry you if you were betting against it right now?
Respectfully, I want to push back slightly on that framing. Gold holding 4,000 is positive, yes, but it also came off a higher level. Down 1.5% in a week is not nothing. The question I'm asking is whether the macro tailwinds that pushed gold to 4,000 are still intact, or whether we're seeing the beginning of a consolidation phase.
That's a fair point, Maya, and I'll give you this. The absence of central bank buying in the news this week is notable. Central banks have been one of the biggest drivers of gold demand over the past few years. When that goes quiet, it removes one layer of support. We didn't see major buying or selling reported this week.
Now let's talk about silver. Because silver had a rough week. It bounced off an 8-month low to close just above around $60. The gold-silver ratio right now is about 71. Let me explain what that means. It takes roughly 71 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been closer to 50 or 60, so silver is relatively cheap compared to gold right now.
Jim Rogers has made the case for silver over and over on exactly that basis. He said that when the ratio gets stretched, silver tends to catch up fast, and when it moves hard. The question is always timing. Silver can stay cheap relative to gold for a long time before it snaps back. How do you think that gap eventually closes, Maya?
The data suggests it closes through industrial demand more than investment demand right now. Silver has two jobs. It's a monetary metal like gold, but it's also an industrial metal used in solar panels, electric vehicles, and electronics. If AI infrastructure build-out accelerates energy demand and solar capacity keeps expanding, that industrial side of silver's demand story gets stronger.
Frank Giustra, who built one of the largest mining companies in the world, has argued that silver is one of the most undervalued assets in the world relative to its industrial importance. He's pointed to the supply constraints in silver mining as a factor that the market is consistently underpricing. Please hear me out on this one. If both the monetary and industrial demand stories are valid, silver's setup is compelling.
I agree with the structural case for silver. My concern this week is that silver underperformed even gold during a week when geopolitical risk was elevated. If Hormuz tension can't push silver higher, what will? The investment demand side has been slow to show up. That's the gap in the bull case right now.
For anyone watching who is thinking about where metals fit in their financial picture, here's the simple version of this week. Gold is holding a key level in the face of real pressure. That's a sign of underlying strength. Silver is cheap relative to gold and has a compelling long-term story. But neither metal is making a dramatic move right now. The market is in a wait-and-see mode on the Fed.
The phrase rate relief fades in this week's headlines is the key phrase to understand. A few months ago, the market was pricing in multiple rate cuts this year. Now, with inflation data coming in and yields staying firm, those expectations have pulled back. When rate cuts get pushed further out, gold loses one of its tailwinds. That's the honest context for this week's pullback.
Gerald Celente, who has been tracking gold markets for decades, has consistently argued that the macro forces driving gold higher, debt, currency debasement, geopolitical instability, are not going away. They're structural. A week of yield pressure doesn't erase that. I've been wrong before, but I think this pullback is noise against a much larger signal.
Net summary on metals this week. Gold held 4,000, which matters. Silver bounced from an 8-month low, which is at least a floor. The macro headwinds are real but not new. And the geopolitical risk from Hormuz is a wild card that could flip sentiment fast. We'll be watching both of these closely next week. Scene 23.
Robert Kiyosaki has said for years that gold and silver are not investments. They're insurance. And insurance looks most expensive right before you need it. That framing is worth keeping in mind as we watch these metals hold their levels in a challenging environment. This is not financial advice, but the insurance analogy is one I find useful.
Okay, let's shift gears. Coming up next, Bitcoin. The BlackRock CEO just made a bold 12-month prediction for crypto. And we look at whether ETF flows are making Bitcoin act more like gold or more like a tech stock. Crypto segment is next.
All right, Bitcoin. It finished the week at around $65,000, up just over 0.5%. I want to say that slowly, 0.5%. In a week where gold pulled back 1.5%, Bitcoin barely moved. For something that gets called digital gold, that's a pretty quiet week.
Let's look at what the data actually says about why Bitcoin was so stable this week. The main story is ETF flows. Institutional money coming in through Bitcoin ETFs has been acting as a stabilizer. When retail sentiment gets shaky, the ETF bid provides a floor. That's a structural change from how Bitcoin used to trade, and it's worth paying attention to.
Here's my concern with that ETF floor argument, Maya. When institutional money stabilizes an asset on the way down, it can also cap the upside on the way up, because institutions have risk limits and rebalancing rules. Bitcoin used to be volatile in both directions. Is it possible that ETF adoption is making it more like a boring bond and less like a high-octane asset?
That's an interesting tension, and I think it's partly true. But here's the other side of it. ETF adoption also means Bitcoin is now in portfolios that never held it before. Pension funds, endowments, wealth management accounts, that's a much larger pool of capital. The stability might just be the asset maturing. Less volatility isn't necessarily bad.
Fair enough. Now let's talk about the big headline this week. The CEO of BlackRock issued a 12-month Bitcoin and crypto price prediction. BlackRock is the largest asset manager in the world, managing something in the range of $10 trillion. When their CEO talks publicly about Bitcoin's 12-month outlook, the market listens. What did the data around that tell you, Maya?
Okay, so here's what's interesting about that headline. The fact that BlackRock's CEO is making public 12-month Bitcoin predictions at all is the signal, not necessarily the specific number. 2 years ago, that would have been unthinkable from a firm that size. It tells you that Bitcoin has crossed a threshold in terms of institutional legitimacy. That's a structural shift.
I'll give you that. And there was a second headline this week connecting Bitcoin to a prediction about gold reaching something like $28 trillion in total value. The argument being that if gold reaches that level, Bitcoin, as a competing store of value, could see what analysts called spectacular price moves. How do you think that kind of gold-Bitcoin comparison lands with institutional investors?
Respectfully, I think those gold to Bitcoin projection headlines need a hype check. The logic is, if gold goes to X and Bitcoin captures some percentage of gold's market, then Bitcoin goes to Y. That math works on paper, but it assumes Bitcoin actually captures that market share, and that's the variable that's far from certain. The narrative is exciting. The execution is the hard part.
You know what, Maya? You might be right on that. I've seen that style of projection applied to gold, silver, and Bitcoin for years, and the math always works until it doesn't. What I find more useful is watching behavior. Is Bitcoin actually acting as a safe haven this week when geopolitical risk is elevated? The answer from the data looks like not really.
That's the honest read. Bitcoin was up 0.5% in a week with Hormuz tension and equity slippage. Gold was down but held 4,000. If Bitcoin were truly a safe haven asset, you'd expect it to move more decisively when risk rises. Instead, it tracked somewhere between a safe haven and a risk asset, which is kind of where it's been living for a while now.
The broader crypto market was quiet this week beyond Bitcoin. No major altcoin stories with significant news attached. The macro picture for crypto right now is one of cautious optimism. Positive sentiment on 12-month outlooks, ETF flows providing stability, but no explosive catalyst this week. The market is waiting for something to break the range.
For anyone watching who holds crypto alongside metals, here's the simple takeaway from this week. Bitcoin's stability near around 65,000 is not nothing. It's holding a level. But the muted reaction to geopolitical risk this week is a data point worth filing away. If you believe in the digital gold narrative, you want to see Bitcoin react to fear the way gold does. This week was a mixed signal on that front.
Bottom line on crypto this week, Bitcoin is sitting near the bottom of its 200-day moving average, which means it has higher potential. Institutional adoption continues to mature through ETF flows. The BlackRock headline is a signal about where the industry is headed, but the safe haven test this week was inconclusive. Coming up, AI news, and this week's story out of China is one you need to hear.
Okay, AI news, and I want to start with the China story because I think it's genuinely significant. A Chinese company called Moonshot AI released a model this week called Kimi K3. It's open source, meaning anyone can download and use it for free, and in coding benchmark tests, it outperformed the top models from OpenAI and Anthropic. Please hear me out on this one because the implications run deep.
Let me make sure I understand this correctly. A Chinese company released an AI model for free that is technically better than the paid products from America's leading AI companies? And this model can handle something like 1 million tokens of context, meaning it can process an enormous amount of information at once? That's a significant competitive development.
That's exactly right. And here's why it matters for investors watching this show. The business model of companies like OpenAI and Anthropic is based on charging for access to frontier AI capabilities. If a free open source model from China matches or beats those capabilities, the pricing power of US AI companies comes under pressure. That's a direct hit to their revenue model.
And this isn't the first time we've seen this pattern. Earlier this year, another Chinese model caused a similar shock to AI markets. The pattern seems to be US companies spend billions building frontier models. Chinese labs release open source versions that are close enough to be competitive, and the gap between paying for AI and getting it free keeps narrowing. Wouldn't that worry you if you were an investor in US AI companies?
It's a real risk, but here's the other angle. If AI capabilities become cheap or free, the companies that build products and services on top of AI could benefit enormously. Lower input costs, more powerful tools, faster innovation. The disruption hurts the model builders but could help everyone else. That's the optimistic read on what Moonshot AI just did.
Now, the second AI story this week is about regulation and energy. New York issued an order pausing large data center construction for a year, citing the enormous amount of electricity that AI infrastructure demands. And Europe is pushing forward with restrictions on how AI can be used. These are not small developments for the AI industry's growth trajectory.
The energy angle is the one I find most interesting from an investor perspective. AI data centers are consuming electricity at a rate that is straining power grids. New York pausing construction for a year is a signal that the build-out can't just happen anywhere. It has to happen where the power is available. That reshapes the geography of AI infrastructure investment.
And there's a workforce angle, too. Studies this week found that many employees are spending nearly a full workday per week just managing and supervising AI tools. They called it bot sitting. That's a real cost that doesn't show up in the productivity numbers yet. And some tech companies are now facing lawsuits over using AI to make layoff decisions. The human cost of this transition is starting to generate legal and regulatory friction.
For anyone watching who is thinking about how AI affects their financial life, consider this. The AI story right now has two competing forces. One is incredible capability growth that is becoming more accessible and cheaper. The other is rising costs from regulation, energy constraints, and legal exposure. Those two forces are going to collide, and the outcome shapes which AI investments win.
I'll add one more layer to this. The combination of Chinese open source AI and Western regulatory pressure is creating a genuinely unpredictable environment for AI investment. And historically, when uncertainty goes up in technology sectors, money flows toward things that are less correlated with that uncertainty. Which brings me right to our Tie Together segment.
Okay, the tie together. This is where we connect this week's crypto and AI stories back to the case for precious metals. Let's start with the crypto connection. Bitcoin's ETF-driven stability is making it trade more like a traditional asset. And this week, it didn't surge on geopolitical fear the way gold did. What does that tell us about the metals thesis?
Here's my read. The fact that Bitcoin didn't drain money away from gold this week is actually a positive signal for metals. ETF flows into crypto did not appear to cause outflows from precious metals. These two asset classes are coexisting right now rather than competing. For someone who holds both, that's a reasonably comfortable picture.
I agree with that, Red. Now let's look at the AI connection. The two AI stories this week, the Chinese open source model and the energy and regulation story, both point in the same direction. More uncertainty about where AI economics are headed. And uncertainty, historically, has been good for gold.
Let me build on that. When a Chinese company can release a free model that beats American AI giants, it creates questions about the valuations of those companies. When those valuations wobble, investors look for things that are not correlated with tech sector risk. Gold has been that thing for centuries. The more chaotic the tech landscape gets, the stronger that argument becomes.
Here's where I want to push back slightly. The AI energy story is interesting for silver specifically. AI data centers need enormous amounts of electricity. A meaningful portion of that electricity build-out is going to come from solar power. Solar panels use silver, lots of it. So AI's energy demand is actually a potential demand driver for silver, not just for gold.
I've said it before and I'll say it again. Silver might be the poor man's gold. And yes, Maya, I know you hate when I say that, but the industrial demand story for silver is real and it's growing. The AI infrastructure build-out, the solar expansion, the EV transition. Silver is in all of those. The monetary case and the industrial case are both pointing the same direction.
I'll let the poor man's gold comment go this time because the point is valid. But here's the honest check on the AI to metals connection. Right now, analysts say the link between AI infrastructure demand and gold and silver buying is still indirect. It hasn't translated into measurable price support yet. The thesis is sound, but the market hasn't fully priced it in.
Which is either a warning or an opportunity, depending on how you look at it. If the thesis is right and the market hasn't priced it in yet, that's actually when you want to be paying attention, not after the move has already happened.
Let's land this segment. Net-net, this week's macro picture for precious metals is neutral. Gold held 4,000, which is positive. Silver bounced from a low, which is a floor. Crypto didn't drain metals interest. AI uncertainty adds a modest tailwind. But rate cut hopes fading is a real headwind. It balances out to neutral with a slight lean toward cautious optimism.
I'll take neutral in a week where yields were rising, the dollar was firm, and rate cut expectations were pulling back. Gold holding 4,000 in that environment is actually a quiet statement of strength. The metal doesn't need everything to go right. It just needs enough uncertainty to stay relevant. And this week, there was plenty of that.
How do you think the Hormuz situation plays out over the next few weeks? If oil markets stay nervous, inflation expectations could tick back up. And if inflation stays sticky, the Fed's ability to cut rates gets more complicated. That chain of events would be a meaningful tailwind for gold. It's the scenario worth watching most closely right now.
That's the scenario I'm watching too. Hormuz tension, oil prices, inflation expectations, Fed response. That chain could move metals fast if it escalates. For now, we're in a holding pattern, which brings us to the prediction. What are Rich and Maya calling this week? Let's get into it.
Before we get into this, we want to be clear. This is for entertainment purposes only. This is not financial advice. Now, Rich, what are you thinking for this week's prediction?
Here's where I'm landing. The Fed has been signaling patience, yields are firm, and rate cut expectations have pulled back. But geopolitical risk is rising and inflation is not dead. My prediction is that the Fed is going to find itself in a corner before the end of the year, forced to choose between fighting inflation and supporting a slowing economy. And that choice is going to be a major catalyst for gold.
I'm directionally aligned with you, but I want to frame it differently. I think the more precise prediction is this. The window for rate cuts that the market was pricing in earlier this year is closing. And as that window closes, gold's story shifts from rate cut optimism to something more durable, which is inflation persistence and geopolitical uncertainty. That's actually a stronger foundation for gold than rate cuts alone.
I like that framing. Let me try to land us on a single call. Our prediction is that the rate cut narrative, which drove gold's early 2026 rally, is going to fade. But rather than pulling gold down significantly, we think gold finds a new floor supported by inflation persistence and geopolitical risk. The rally's original engine changes, but the destination stays the same.
I can agree with that. The prediction is that gold's support base shifts from rate cut hope to inflation and geopolitical fear, and that this shift actually makes gold's position more durable heading into the second half of the year. Rate cut hope is a narrative. Inflation and geopolitical risk are structural. Structural support is harder to take away.
And the corollary for silver is that if this prediction is right, silver's industrial demand from AI and solar eventually closes that gold-silver ratio gap. The ratio is stretched at 71 right now. We think it trends back towards 60 or below over the next several months as silver's dual role as both a monetary and industrial metal gets more attention.
That's our call. Gold's support story shifts but holds. Silver's ratio gap closes over the next several months. And the biggest risk to being wrong is if inflation actually comes down faster than expected, which would give the Fed room to cut, and that scenario would change the whole picture. We're watching inflation data in Hormuz closely.
What do you think? Do you agree with our call, or are we way off? We're saying gold's foundation shifts from rate cut hope to structural inflation and geopolitical support, and silver closes the gap with gold over the next few months. Drop your take in the comments. We read them. Well, as AI hosts, we process them, but it amounts to the same thing.
Quick recap. Gold held 4,000 in a tough week. Bitcoin held 60,000 with ETF stability. China's moonshot AI shook up the industry. And our prediction? Gold's support shifts to structural drivers. Silver closes the gap with gold over the next few months. If you found this useful, like and subscribe so you don't miss next week.
Next week, we'll be watching the Hormuz situation, any Fed signals, and whether silver starts to close that ratio gap. Until then, I'm Rich the Stacker.
And I'm Maya Tech. See you next week.